Hey, Dave, thanks for taking out the time and chatting with us today. I appreciate you cutting out some time for us.
Thanks for having me on the show, Peter. Looking forward to it.
Yeah. Well, so before we jump into what you're doing currently, give us a little background of who you are, and then we'll get into the rest of the show.
Yeah, so I am a Lancaster, Pennsylvania resident, have been all my life. In fact, I live just a few miles from where I was born, and I grew up in this community. And my family has a modular building business. So I grew up in that space, and I was early on. I had made the decision after watching my dad invest his money in real estate. He was very successful, is a very successful businessman, and he invested his money into real estate, farms, land, single family homes. I watched him self-manage some of those single family homes, and I quickly decided that that was never going to be me, and that I wasn't going to be a real estate investor. And so I went down the path of business, and I started several businesses, partnered in several businesses, and got to the point where, in a little more than a decade ago, I got to the point where I ended up with a $500,000 a year tax bill, and was doing really well, having a lot of fun. But it was after I got hit with taxes that I really got to thinking, this just isn't so much fun when you got to give half your profits back to the government. And so I kept hearing Robert Kiyosaki talking about how you can make millions of dollars a year and pay no tax legally, and that drove me crazy. I had to figure out what he was talking about, because nobody in my circles knew anything about that. It was always, I was taught from my dad and his CPA and really from everybody in my circles that if you make a lot of money, you got to pay a lot of tax, right? Mm-hmm. Conventional wisdom. And so I didn't know how to do it any other way. And it was after getting with Robert Kiyosaki and his tax guys and his real estate guy and really digging in that I soon figured out that real estate can be a much more than a vehicle to build long-term wealth, cash flow, equity growth, all that, but it can be a tax protection vehicle. And so I got into the space through that angle. And of course, after being in there and managing my tax liability and now making multiple times as much money as I did back then, I live tax-free or tax efficient. And it's just really by using strategies that are in the tax code that I can legally, that the government encourages me to use, that I can legally make all kinds of money and pay no tax.
Yeah, I mean, that's so jumping right into it. I mean, that's a lot of people's, for one, frustration with, when you hear someone like that say, well, I don't pay any taxes. Well, there's certain loopholes, like you say, and they're legal loopholes where you go into the tax code and you're able to, like cost segregation and those types of things that ultimately provide you the ability to not pay any taxes because you're spending a lot of money on properties or, depreciation and you name it, right? Going into those strategies. And I was just thinking about this yesterday is, there's been, people for years that have been able to do this and then ultimately, get around the tax, the taxes because they are providing, more properties and also doing all this real estate investing. So since, going back to that, initial light bulb where it's like, okay, well, I need to start saving more on taxes. How did you go about that? Did you, you said you seeked out a couple of different CPAs. How'd you get to those CPAs and how were you able to get in contact with them to get you into the strategy of doing this?
So first I want to go back and just kind of hone in on a couple things you said. One is, tax loopholes. Another one, talking about how to get around taxes. I don't see it like that. I see it like the IRS desperately wants my help.
Yeah.
And so they put it out there like, look, Mr. Investor, if you do what I want, I will be kind to you. If you don't, I'm going to give you a fine through taxation. And so I really just find areas in the tax code that the IRS strongly encourages me to get involved in, and I just do them.
Yeah.
So I don't see it as a loophole. I don't see it as evasion or getting around tax. I really just
Yeah.
figure out, what does the government want me to do? They want you to go out and create jobs. They want you to go out and create housing. They want you to buy new equipment that create jobs for other companies, and they tell you they want you to go out and look for energy and invest in energy, drill oil and gas wells. They want you to do all that stuff, and they so desperately want you to do it that they will pay you handsomely through tax rebates. And that's really all I'm doing, is taking what the government wants me to do and doing it. And then back to your question about a CPA. I got around Robert Kiyosaki and his team. Tom Wheelwright at the time made a statement that changed the course of my life. One of the things he said was, if you want to change your tax, you got to change your facts. Meaning, if you want to change your facts, or if you want to change your tax, you have to do business differently. You got to think differently. You got to invest differently. And so I signed up with his firm at Provision. Tim Gertz is my guy, and probably one of the best tax strategists in the country. And so we talk a lot, and we're always figuring out complex tax problems or challenges for not only me now, but also for our investors. And so I'm immersed in this space, on a daily and weekly basis. And so, really just getting around world-class people that are the best in the business and teaming up with them.
Yeah, so I'll go back and just reiterate, not getting around the taxes, but just making sure that you are within the guidelines and you're following those to the T, to ultimately help you, and then also help the government, like you said, being able to create jobs and create the ability for other people to make money. Ultimately, provides you the ability to reduce your taxes. So yeah, just a lack of a better phrase, I guess that I utilized. And then, so I know there's a lot of people that say, well, those like Tom Wheelwright, I think he wrote that book. I just pulled it up. So Tax-Free Wealth. I read that one.
Very good book.
Yeah, really good. So he and his team help you out. So there's a person on his team. So there's a lot of people that say, well, that's just too much money for me to spend for a CPA, whatever that number may be. And I've been in the mindset for a long time. It's like, well, I'll pay this person, what they're worth to get those taxes, or look at my taxes at a different angle, because they have a lot more experience than I do. How did you get around that thought process of, okay, well, I'm willing to pay this amount because I'm willing to go the extra mile?
Yeah, no, that's good. That's a good thought, because it does, to get from where you are to where you want to go, you got to think different. The difference between a lower middle class person and a wealthy person is their mindset and the way they think and the way they approach things. And so it's no different than saying, what's it going to cost me to get a cost seg done on my 100-unit apartment building? It could cost me $5,000. Oh, well, that's way too expensive, Or thinking, wait, if I invest the $5,000 to get a cost seg done, that's going to save me $100,000 per year for the next 3 to 5 years. And so it's an investment, to your point, being able to say, I'll pay a little bit more, and you will. I'll pay a little bit more for the best tax strategists in the country to be on my team. But in the end, what does it really cost you? Nothing. If you hire really good people, if you got world-class people on your team, it doesn't cost you money, it makes you money.
Mm-hmm. Yeah, I mean, that's a huge point. Is it ultimately, in the short term and the long term, it doesn't cost you money. You got to get past that thought process and that mindset where it doesn't cost you money. It's ultimately going to make you money. You may not see it. Let's just say you put in $10K and then you don't see it for a year. But ultimately that's gonna push you into a 4 or 5 fold of what ultimately you're spending on your income. So, moving forward, since you've been with that CPA, how many CPAs do you have? So I've talked to people that have 2 or 3. Do you just have one and they focus on a specific aspect, or do you have a couple that focus on different aspects in your tax saving strategy?
Yeah, so I have several, 2 or 3 local CPAs that I can tap into, and oftentimes today it's tapping into those CPAs to help their clients. I'm in a position now where there's quite a few CPAs, seek me out to help them figure out their tax liabilities for their clients. And
Yeah.
so I have multiple conversations. I have many conversations with those CPAs that we try to brainstorm for their clients. So I would say outside of my CPA that I use for probably 95% of the stuff that I'm working on for myself personally, I've
Hmm.
got probably 3, 4, 5, maybe 6 more.
Okay. Okay. And did that evolve into those 5 or 6, or right away was it like, okay, well, I'll hire someone off Tom Wheelwright's team, and then I'll hire these 3 or 4 others, or did it take a little while to get those 5 or 6?
It definitely took a while to get those 5 or 6. And that's 5 or 6 really core, CPAs that I'm talking to sort of on a regular basis. When you look at, my investors now having, probably close to 1,500 investors, and then having their CPAs, sometimes, they had a liquidity event, they had a business sale, they had some kind of a big deal happen in their life. It's not unusual that they'll get their CPA on the line with me, and most of the time we can figure out through a series of questions on my end, we can figure out their clients' needs.
Hmm.
But sometimes if it's too complicated, I'll get my CPA on the line, and now it's me, the investor, his CPA, and my CPA, and we just we just figure stuff out.
Yeah, 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 yeah. That's huge. With you being, this involved with making sure that you're getting the right advice with CPAs and everybody else. What have you seen that is kind of the best real estate product or asset that's helped you in your journey to ultimately go through this process to ultimately not pay as much taxes as someone else that has a W-2 or something like that?
So the very first one was multifamily apartments. I started buying multifamily apartments in 2010, and
Okay.
so the timing was great. I think we bought our last big multifamily apartment project in 2018, 19. I've been a seller since,
Yeah.
but that's what took me from more than a decade ago. That's what took me from $500,000 tax year down to the very next year down to zero. And it was all through creating huge paper losses. Getting creative with that, using some debt to finance your purchase, and then turn around and using cost segregation studies to accelerate depreciation. When you do a combination of debt and cost segregation on your property, it becomes so magical that you almost wonder, like, how can this be legal?
Yeah.
This is legal, really? And
Yeah.
it really becomes pretty obvious, when you're immersed in it, like, okay, this is how this works. And it went, I quickly went to becoming of that mindset of, well, if I got to make if I make a lot of money, I got to pay a lot of tax, to thinking exactly that. I was, working through these complex strategies with my CPA, and there was a number of times I'd stop and scratch my head. It's like, wow, how
Yeah.
can how can this be legal?
Yeah.
But
Um,
it is, and it's strongly encouraged by the IRS. They want you. I mean, look, if you look at the HUD projects and the government financed housing, and you figure out, okay, here's what it looks like when the government takes control and invests their money and builds these projects. When you look at how those projects are run, it becomes very obvious why they would go ahead and give you huge tax breaks to run a successful project to house their folks.
Yeah, for sure. Can you?
In the same way, I mean, you can run that scenario a number of different times. Like, look at the countries that take over and take control of oil and gas wells. Where they throw out the entrepreneur, and they now all of a sudden they nationalize these assets. It doesn't end well, and it never ends well. And so they realize this, and they're like, you know what, we're better off just giving these investors huge tax incentives to go out there and do this stuff for us, because we're not really good at it.
Yeah. I agree with you. Before we get deeper into talking about, what you've been doing in real estate, talk a little bit about, because I brought it up and then you brought it up. Can you explain just a general overview of cost segregation?
Yeah, so it's basically so if you buy a single family home, or if you buy a multifamily apartment building, and you get the normal depreciation, you're looking at a 27.5-year depreciation schedule. So over 27.5 years, the IRS is saying that property goes from being valued at whatever, $1 million, $10 million, whatever your purchase price was, to now being worth zero in 27.5 years. So really what you're doing when you do a cost seg study is you're accelerating or pulling forward those 27.5 years worth of paper losses. You're pulling that forward to the first 3 to 7 years. And so to be able to pull all those losses forward, and then being able to, I'll just give you a quick example.
Yeah, so please do.
If you were to take, let's say, $1 million, and you were able to take, let me take it a step further. Let's say you were taking $1 million in cash, and you were to leverage that up 75% LTV. So now you got $4 million worth of real estate. And then you can take, let's say, 70%. I'm pulling a number out of the hat, but it's, let's say, 65 to 75% of that real estate. And you could do you could pull those losses forward. You could accelerate the depreciation, not only on your money, but also on the bank's money. You end up with a pile of paper losses in that first 1 to 5 years, 1 to 7 years. So and my theory on that is, when I can build momentum is your friend in this space. So if I can take the money that I would have otherwise gave to the government through taxation, and then I can reinvest that. Okay, so now I saved all that cash, and now instead of buying a Ferrari, I'll go out and buy another asset that gives me more depreciation to offset future tax liability. It starts this whole big massive snowball, and you can quickly get momentum. That's what happened to me. That's what I teach to others. I mean, it's momentum, and you really being strategic on the front end. The quicker you can get to the point where you get some momentum, the better.
Well, that's good. You kind of broke that down a little bit. So Dave, if you let's say you kept that apartment complex for 30 years, but can you still do cost seg on the first 1 to 7 years, knowing that you're going to keep that? And then if so, does that hamper any type of returns or taxes later on holding on that property?
Well, once you burn through all of your depreciation, let's say you depreciate 80 to 90% of your building or your asset in those first, let's say, 5 to 7 years. Now you've blown through all that depreciation. Once you've taken all of your depreciation that's available to you, you're going to get taxed on the income now coming from that asset. But that's a very easy income to offset. So now you've got to just be strategic and say, okay, what I go to go buy, what I go invest in that'll offset the tax liability on that income. And so it becomes very easy. I mean, at the end of the day, if you stop and you're no longer strategic, and you just say, look, I want to just sit on the beach and do nothing for the rest of my life. I'm 80 years old, and for the next 20 years, I don't want to do anything. Sure. I mean, you're going to end up paying the tax. But if you're strategic and you get into the game, I know very few people that really get good at this that ever want to quit.
Yeah.
So, if you're strategic and you just continue playing the game, and it is a game, it's a lot of fun. The better you get at it, the more fun it is, really.
Yeah.
And why would you want to stop? And then you just, you got this thing called stepped up basis now where, and that's the thing too, you got conventional thinking that says, well, wait a minute. At some point, well, the first part of conventional thinking is if I make a lot of money, I'm going to pay a lot of tax, right? The second part of that is, well, it's going to catch up to me one day, so I might as well just foot the bill today. So I don't have to worry about that later. Well, that's conventional thinking too, because if you're strategic, if you got a good CPA on your team, if you want to think outside the box, you never pay the tax. You don't pay the tax when you're 70. You don't pay the tax when you're 90. Your kids don't pay the tax, and you've got stepped up basis. I mean, when somebody asks me that question, that's just that's a very uneducated question, because the idea is not to defer and then someday when I'm 60, when I'm 70, when I'm 80, when I'm 90, then I'll pay that tax and I'm gonna have this huge tax bill. Not at all. You never pay the tax.
Got it. So outside of multifamily, is there some other investments that you usually invest in, and what are they?
Yeah, so our core asset classes right now are ATMs, have been for more than a decade.
Okay.
We're one of the top 5 ATM operators in the country. So ATMs, 100% bonus depreciation, strong, very aggressive cash flow. It's just when you blend those two together, I mean, it's a powerful way to control your tax liability and build massive streams of income. Our second core asset class is self-storage. We've done a whole bunch of self-storage in the last 5 years, and I love self-storage. The institutional demand is very aggressive right now. It has been for the last couple of years, and it fits right into our business model. Actually, we kind of created our business model because we saw the institutional demand. But our business model is we buy from a mom and pop. We add some kind of heavy value many times through development. We'll take a 50,000 square foot facility and make it a 75,000 square foot facility, add 25,000 square foot of climate controlled units and stabilize it, put professional management in there, really increase that NOI, and then turn around 3 to 5 years later and sell it to a REIT at some ridiculous low cap rate. Yeah. That business model works very well. But if that business model goes away and the REITs lose all appetite, we don't see any reason to think that they would. But if they would, those assets are great assets to hold for long term as well. So we got several different, sort of exit strategies. Yeah. But we love that asset class.
So you touched on ATMs. I was going to bring that up, but I'm glad you hit that. So how'd you get into ATM investing, and what drew you to that?
I got introduced to my now partners back in 2012. I was a passive investor for a couple of years until after they saw me build kind of an investor network and build my syndication business around multifamily and all. They said, hey, remember, I was a passive investor now for a couple of years and had been, pretty aggressive in the space because I loved it. They came to me and said, hey, we got an opportunity. We've just signed on the largest contract for an ATM portfolio we ever signed on, and we could use some help over here. And I turned them down. I said, look, I've got a couple of deals I'm working on over on my side in the multifamily space. I really don't have a lot of extra time on my hand, but it was coming down toward the end of the year. And they said, look, we have a fund open right now. It's a 100% bonus depreciation fund, meaning that, even if you invest in December, you'll be able to take 100% of the bonus depreciation in December for that year. And so I was very familiar with it for myself because I've been doing it the last couple of years. And I thought, wait a minute, that fits into our business model for a couple of things: cash flow,
Hmm.
and for, tax efficiency, 100%
Yeah.
bonus depreciation. And so I was like, you know what? I really love this investment. I think my investors would too. And I took it out to them, and since then it's, we really scaled the business a lot, and got into that position over the last couple of years to where we're one of the top players in the space.
Is it mostly ATMs at like 7-Elevens, and where are the ATMs placed, and ultimately, like, what type of investment is the business that has the ATM paying you a fee to have it there, and then you're also taking a fee off people on users? How does that work?
Yeah, so there's really a three-way split on the revenue.
Okay.
What happens is the consumer comes up, swipes the card, pays $2, $3, $4 to get the cash out to make that
Mhm.
transaction, and then there's kind of a three-way split. There's
Okay.
the operator, there's the real estate owner, where the ATM, as you mentioned, at 7-Eleven or McDonald's or CVS, Walgreens, some of the bigger chains. They get the split of a portion of the revenue. Then you as an investor get a portion of that revenue. And so the revenue split, the way it works out is the investor in this fund we have open right now, is the investor's making a 24.5% cash on cash return. And so, that's a fixed return. It doesn't go up or down. The reason it doesn't is because our business model is such that, if you make more than the $2,142, we keep anything above $2,142 per month. If you make less than that, we chip in our portion of the surcharge revenue to bring you up to 24. So there's kind of a floor, underneath it, and then it's almost like a preferred return. So it really becomes, now before you get all excited about that return, you got to realize that you're also losing your asset over 7 years. So
Okay.
unlike an apartment building where the cash on cash return is usually lower than the IRR, here it's the opposite, 24.5% return cash on cash. But when you consider the fact that you're losing the value of your equipment over that 7-year period, it becomes more in line with an 18.5 to 19% IRR over that 7-year period.
Got it. And what do they say usually after 7, 8 years that the machine's void? They got to put a new one in. Is that pretty much the standard?
Yep. So our contract is for 7 years with the investor. At the end of 7 years, and that's pretty much the life cycle of an ATM. At the end of 7 years, we're selling an ATM at scrap value.
Yeah.
So really, you're losing most of your investment or your investment principal. So at the end of 7 years, contract stops, the deal's over, you're done.
Okay. And then do you guys source it to one specific ATM manufacturer typically? So you go to one source?
Not to one. We have our sort of primary manufacturers, but not to just one. We've got we've got deep connections in the space, especially in the last couple of years now, where we've moved to one of the top sort of positions in the space. So we're very well connected in the space. We've got multiple avenues for it, which is kind of a hedge or a diversification play for us.
Yeah.
But no, it's you can imagine in the much better known asset class of multifamily apartments, you got the whole infrastructure around multifamily apartments. You got the brokers, you got the bankers, you got the the sales guys. You really have the whole infrastructure around multifamily apartments. There's a whole infrastructure around ATM investing. It's just a lot smaller.
Got it. So you've built a lot of relationships, a lot of partnerships, a lot of teams. It sounds like, to get to where you are today. What would you say is a couple of takeaways from building those relationships and teams to be successful in a certain pursuit that you're going after?
Number one, you got to be a good partner.
Okay.
Just like I'm out looking for a great partner. If I want to get exposure to a specific asset class, let's say in the self-storage space, they're looking for a great partner as well. So I'm looking at their track record. They're betting me. They're looking at my track record. I'm telling them I can raise whatever. I can raise $50 million in the next fund. They're looking at me saying, well, you know what? Who is this guy? Can he do it?
Yeah.
Normally, in the last 5 years, especially, I've been, typically when I get involved with an operator, it's through a personal connection and referrals. Like if you're cold calling me saying, "Hey, I'm Big Bob's self-storage, operator," you're not going to get my attention. But if I hear your name over and over again in my investor community, and I'm hearing all the kinds of good things about you, you're going to get my attention. And so, typically, I mean, that's a giant head start. That's a giant step in the right direction. And then, they're looking at me saying, "Is he a good partner?" So you want to attract great people. You got to be a great person.
Yeah.
You just can't, doing good deals with bad people. I don't know if that ever happens.
Yeah, it's true. With going back to the partnerships and building those relationships when you're signing on the dotted line, is there agreement that you set up with these partners, and how have you kind of structured that? Is there a one size fits all, or do you always have a different agreement set up for different partnerships?
Well, I teach this stuff. in the syndication events, and
Mhm.
I teach about different asset classes and different deal structures, and this every deal is different. Once you, I'll just give you an example. Like our self-storage team, we have a structure that works for our team. We have a structure that works for the operator. We know going into the deal what it's going to look like. So we sort of have our structure, but different deals and different asset classes. I mean, you can get creative with it, and you can tweak the model. Once you have a model that really works, I always like to make sure that when I'm putting a deal together that I'm very much aligned with my investor. I don't typically take big fees up front. I want to be on the side of, and it's different for every asset class, but typically I'm on the side was, okay, after you've made your return, then, and let's say there's some left, then I get paid. I don't get paid, most of the time I'm not getting a dime until you're either getting your preferred return, or you're getting 100% of the return, or you get, after that time period. So there's all kinds of different ways you can structure deals. And, being in this space for, more in the last decade, you learn things, you watch what other people are doing, you sort of figure out what's working and what's not, you tweak the business model, but at the end of the day, it's got to be good for the investor.
Yeah, for sure. I agree. Dave, if I was to say, hey, in the next 3 to 5 years, what are you kind of looking at for business wise? What do you see for yourself? Not what the market looks like, but what do you see for yourself, moving forward?
So I get asked this question, like, how do you run around and find these things for your investors? And, how do you put this stuff together for your investors? And it's pretty simple answer, and it may sound selfish, but it really starts with me. I've got a tax problem. I got to figure out how to offset tax liability on my income, on the passive side, on the active side. So I'm basically, the way I see it is I got an income. I got a bucket of income on the passive side. I got a bucket of income on the ordinary or active side. And then I've got, of course, the liquidity events, capital gains, whatever. But I got a couple different buckets of income. Now, when we get down toward the back half of the year, I'm starting to pair up investments to those different income streams, or to the different buckets of income. Okay, so I got this income over here that if I do nothing, I'm going to get taxed at whatever, 20% or 37% or whatever that looks like. I got to find an asset class that will give me the depreciation I need to offset the tax liability on that income.
Yeah.
So really what I'm doing for my investors then is I'm really just taking what I'm doing for myself first and sharing those resources, relationships, those asset classes, those tax strategies. I'm really just taking what I'm doing for myself and sharing it with a bunch of other folks.
Yeah. 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 No, that's good. That's good. That's huge. I mean, especially, these days with, increases in taxes and inflation and stuff like that. It's definitely a challenging financial world. What do you see for the multifamily space and stuff like that in the next couple of years? You think it's still gonna continue with a lot of syndications, and do you see that route still going in the next 2 to 5 years?
Well, it's been one of the most popular, probably the most popular asset class in the last decade to syndicate. And I know I have a bunch of friends in the space. So one side of me wants to say, well, wait a minute, this has been a bull market cycle in this space for the last 12, 14 years.
Yeah.
We're probably closer to the top than we are to the bottom.
Yeah.
The other part of me wants to say, well, wait, they just pumped $4 trillion, probably more than that. They just pumped a whole trillions and trillions of dollars into the economy. Where's that money going to go? It's
Yeah.
going to go into Wall Street. It's going to go into real assets. It's going to go into apartment buildings. It's going to go into self-storage facilities. It's going to go, so I'm always, trying to look at it from two angles. Like, wow, this is a peak of the market. And then I'm thinking, well, wait a minute. What about all that money that they just pumped in there?
Yeah.
It could keep going for a couple of years. I think, I mean, for myself, diversification is key. Not
Mhm.
having all your eggs in one basket, making sure that, no matter what happens, you're protected.
Yeah.
But I don't know. Who knows? It could keep going for a while, but I want to be prepared if it doesn't.
Yeah, no, for sure. I mean, I like, most people that I interview here, everybody obviously doesn't have a crystal ball, they're always trying to think about, what's going to happen next. But at the same time, like, they reiterate just what you said. We're, we seem to be going for, a long time, but at the same time, what happens in an inflationary market, a lot of real property ends up going up, and then the rents go up too, which a lot of people stay bullish on that just because of where we're at in the market.
I do know this. If there's another round of eviction moratoriums and people figure out that they don't have to pay rent, and the temps drop down below zero in the Northeast, I may not be able to collect my rent,
Yeah,
but I will get a premium for my gas. So I
that's
mean,
true.
I just like to take the approach of having some diversification. Really, no matter what happens, you've got a good hedge against. I mean, you would like to think that every asset you own is going to do well 100% of the time. It's probably not true,
Yeah,
but I would say diversify, hedge yourself a little bit, just make sure you're covered in any market.
yeah, for sure. I agree. Well, let's move to the last couple of questions I got for you. If you had to pinpoint, one or two books that you've read over the course of the last couple of years in business or real estate, what would you say is a one or two that are really good?
Um, this is going to sound everybody's got to read Rich Dad Poor Dad.
Yeah.
Everybody, if you haven't read it, get the book and read it 2 or 3 times. But recently, I read a book like okay, so I'll say this: if you're in business and you're having some success and you've really got some momentum, make sure that you read Hunger in Paradise. It talks about staying hungry and not getting lazy when things go really good, and continuing to work hard for your customer, and not let it become all about the bottom line and sales and all that. So Hunger in Paradise is a really good one. I'm actually about 90% done with the book right now.
Okay. All right. I've never heard of that one. Let's see. Who's okay. I just wrote that down. And then What about a tool or online resource that you use for investing or business that's helped you be more efficient?
I really I don't I thought about that a little bit when you asked me that. I really don't use anything fancy and complicated, financial calculators, really a lot of that stuff. I do a lot of reading though.
Okay.
I read articles on self storage. I read articles on ATMs. I'm tapping into what's current in the market. And so I read a lot from industry professionals and industry, thought leaders and all that. And that helps me really oftentimes really make good decisions.
Good. Nice. Yeah, I try to, the last like few years I've picked up a lot more reading. And I feel like each year I try to read more and more just to make sure I'm well rounded, especially on, conversations or just investing and stuff like that. So that's super helpful. And where can people, if they're looking around for you to get more information on ATM investing and syndications and multifamily, where can people find out more about you?
Our website is therealestatinvestor.com. And
Okay.
you can reach out to me or my team by sending an email to info@therealestatinvestor.com.
Okay. I'll put that up on the show notes too. Cool. Dave, is there anything that I didn't ask you that we should cover before we jump off here?
One of the things as a sort of due diligence, and this is one of the things that we get asked a lot, and I'm talking specifically about ATM investments. In our peer group, anybody that's paying attention, people that are listening to this show, um, we've long since converted to plastic. I would bet to say that very few of your listeners even do a lot of cash transactions.
Yeah.
And then so that gets people thinking, well, wait a minute, if I don't use it, that means it's probably not a relevant investment opportunity, or that means everybody else isn't using it either.
Yeah.
Well, the general rule is that if you have enough of money to invest in an ATM, you're probably not an ATM user. And so our demographic is unbanked, underbanked, EBT card users, lower income, immigrants, those kind of folks. And when you look at the demographic of folks, one of the fastest growing demographic of folks, and then you also realize that more than 40% of the currency that's ever been created has been created in the last 2 years, and you kind of pair those two together, then that business model becomes very much relevant, and you start to get the picture a little bit more. But it's the same as in any business. You got to figure out, okay, who am I serving? Who
Yeah.
are my customers? And so when you get your mind around who that is, then it becomes a lot easier to understand.
Yeah, for sure. No, those are great points. Stuff that I didn't even think about, especially when we're talking about ATMs and investing like that. That's huge. Something I feel like at times people don't they hear about some type of investment strategy or asset class, and they don't really look at what their demographic is or their avatar is. And I'm glad that you hit those bullet points.
Yeah, it's probably in business, and I have owned and operated and still own several different ones in different sectors. It's probably one of the more important things to understand about your business is, okay, who am I serving?
Yeah.
How can I serve them really well?
Yeah, no, for sure. I mean, you got to know that avatar, and then you also got to make sure that you're serving them properly and you're speaking the same language as what they're speaking.
Right
So
on.
that's huge. Well, Dave, thank you so much for your time today. I really appreciate it. We dove into a lot of different categories that honestly I haven't dove into on this podcast. So I appreciate your time.
Thanks for having me on your show, Peter. It was fun.
Yeah, man. Thank you so much. You have a good day.
You got it. Bye.